Hello everyone, this is Arjun with QuantInsti, and I hope all of you can hear me clearly. I am an Assistant Manager of International Sales with QuantInsti, and I welcome all of the participants today to the webinar on Implied Volatility, from theory to practice. I'm very pleased to have Arnav Sheth with us, who will be delivering today's presentation. In the presentation, Arnav will cover introduction to different kinds of volatility, how to use implied volatility, a few of the numerous trading strategies that exploit various characteristics of implied volatility, available online resources, i.e. that is academic and practitioner research, various Chicago Board Options Exchange indexes to help you get started. But before we start with the presentation, as a reminder, this session is also being recorded and everybody will receive a link to the recording by email after the event. If you would like to ask questions during the webinar, please feel free to simply type your questions in the question and answer window located at the right-hand side of the screen. And now I would like to introduce our speaker, Dr. Arnav Sheth. He is the Director of Masters in Financial Analysis and Investment Management at St. Mary's College of California, where he's a full-time professor. Prior to that, he was an economist with Deloitte Tax and a lecturer at various departments at the University of California, Berkeley, including the Haas School of Business. He has studied, researched, and thought about volatility for almost all of that time and has consulted on derivative contracts with numerous firms. He published his first book, Optimal Operating Strategies under Stochastic Cash Flows, in 2011. He started Gaji Analytics, a consultancy, in 2014 and was technical co-founder of Profit Modeler, a financial analytics platform, in 2015. He is also involved as a researcher with several active management firms and hedge funds and is frequently called on to advise fintech firms in the Silicon Valley. He has a bachelor's in economics, mathematics, and philosophy from Lawrence University, and a master's in behavioral economics, an MBA in finance, and a PhD in quantitative finance from Rutgers University, working with the late mathematician Larry Shep. Outside of his work, he's interested in climbing. He's done 4 expeditions to the Himalayas, distance running, he's completed 3 marathons, and open water swimming, in which he's also completed the swim from Alcatraz to San Francisco. Hi, good morning, Arnav. I'll request you to take it from here, and I'm handing over the presenter rights to you. Thanks, and you can actually take the control from here. I'm just turning on your mic, and the show is yours. Arnav, can you hear me?
Yes, I can hear you. Thanks, Arjun. That was very flattering. Appreciate the introduction.
Great. Thanks for that, Arnav, and I hope you have a fantastic webinar, and I hope all of our attendees enjoy the webinar too. The stage is yours.
Great. Thanks, Arjun. Good morning, good afternoon, good evening, everyone, wherever you are in the world. My name is Arnav Sheth. I am, as Arjun said, a professor. So that means I am primarily a teacher, and I consider my job today to make sure that you guys are understand the concept of implied volatility before the end of the evening. Now that's it's a pretty challenging task because Generally, people take about 10 years or so. You need to get a few degrees in advanced mathematics, understand specifically how the advanced mathematics is applied to finance, etc., etc. But I'm going to make sure, I'm going to attempt to make sure you guys understand it in 40 or 45 minutes that we have here tonight. All right. All right. So let's get started. Just a brief outline. I'm going to go over some of the basics of options. Not exactly sure who the audience is, what your level of knowledge in terms of options is. So just to get everyone up to speed, I'm going to cover a little bit of the basics, and then we'll jump into pricing and all of the different kinds of volatilities, which are the historical volatility and the implied volatility. And then we'll talk about the characteristics of implied volatility, and then I will introduce one trading strategy in a fair amount of detail, just to give you an idea of how people think about these things. And then a couple of the CBOE indexes. And finally, I'll hand it over back to Arjun, who will talk a little bit about EPAC. Feel free to send me any questions in the chat box. We do have a limited amount of time, so I'll I'll try and address the questions that are the most relevant. There are also a lot of you there, so I do apologize in advance if I don't get to your question before the end of the evening. All right, let's get started. So I always like to start any talk about options with the history, because I find that a lot of people really don't know when and where options were first invented or discovered. So it turns out that they're much older than you think. They were first, the first recorded options contract was back in about 500 BC or so. It was started by this mathematician philosopher whose name was Thales, and he was very poor, but he was also apparently very smart, because what he did was he put all of his savings into reserving the olive presses. So in Greece, that was the big crop. And once everyone harvested the olives, they were pressed to release olive oil. And if there was a bumper harvest, then all of the olive presses were booked up, and it was very difficult to get a place where you can press your olives if you're an olive farmer. A lot of people were olive farmers back then. So what Thales did was he booked up all of the olive presses, and as it turns out, there was a bumper harvest. And people paid a lot of money to use those olive presses. He essentially had a monopoly and could charge whatever he wanted. He made a lot of money, and turns out he traveled the world. He was one of the first people, first few recorded instances of knowledge transference between ancient Greece, Mesopotamia, and even India. So what Thales did there was he bought a call option on the olive presses. He said, I'm going to pay all of the owners a little money right now, and in return, I own the olive presses, at least for the period of harvest. And that was the first known instance of a call option. So let's go into a little bit more detail. Let's move into modern times and specify what is a call option. So an option in general is a contract that allows one to speculate or hedge on the future of an underlying asset. And a call option in particular will give you the right but not obligation. So you always have the option, as it were, to exit, to not exercise. Unlike a futures contract or when you buy the security itself. So in this case, in this example, I'm buying 100 shares of PepsiCo stock for $100 a share, and that means no matter what the stock price is at the end of the contract, I can buy it for $100. Okay, the contract itself, let's say, costs me $5. And where I make money as an options trader is if the stock is trading for more than $100 plus the $5 cost, then I end up making a positive profit. Okay. So just a brief terminology, a brief slide on terminology. 100 in the example above was the strike or exercise price. April was maturity or expiration. PepsiCo is what we call the underlying asset, or sometimes simply just call the underlying. And if the price of PepsiCo at expiration is greater than 100, the option is in the money. And if not, the option is out of the money. Okay. And just a little bit on notation. K is the strike or exercise price. Capital T is maturity or expiration. Little t is where we are at right now. So it could be any time between now and expiration. And S is the price of the underlying. In this example, or in any example with having to do with call options, if the stock price is greater than the strike price, the call option is in the money. And if the stock price is less than the strike price, the call option is out of the money. And here we have just a profit graph for what a long call looks like to the buyer. So what does the profit look like to the buyer? This is profit and loss. On the horizontal axis here, we have the terminal stock price, the value of the underlying when the option is exercised. And on the vertical axis here, we have profit, and there's a familiar hockey-shaped structure here. This negative portion, the negative portion down there indicates the cost, and as I said earlier, the cost of that option was $5. It's a hypothetical option. All right, and you can see that unlimited upside for a call. It just depends on how far up the stock price goes, and the downside is capped. So you can immediately see a benefit of buying an option. Okay, your downside is capped. You have a floor on the downside, which is just the price of the option itself, and your upside is potentially unlimited. Now, we are not limited to speculating that the price of an asset will increase. We could also bet that it might decrease, and that's where we have put options. So in this example, I have a put option expiring in April. It's on Walmart, and the strike price is $70. The price of the option itself is $7. Okay, and here I make a profit if the price of Walmart goes below 70, because what I'm doing here is I'm betting that I can sell Walmart for $70 to, let's say, you, and in return, no matter what the market price is, so if the market price is 65, then I benefit because I sold it to you for 70. I made $5 there. All right. Now, of course, I have to make more than 77 here. So here is the profit graph for the buyer of a put option. All right. It's not like the call. You don't have unlimited upside. Your upside is limited by the price of the share itself at the time. Okay. And you maximize your profits if the stock price essentially goes to zero, which is so it's a pessimistic security. It's a pessimistic contract. I find that a lot of people don't understand this thing as well. Options trading is a zero-sum game. That means for every winner there is a loser, and for every dollar in profit that goes to the winner, it comes out of the pocket of the loser. Okay, so if you add up the profits and losses of the buyer and seller of any option, it always equals zero, and it's important to understand what the short position looks like. And here you can see I've just flipped it over the horizontal axis, the x-axis. So now it is +5 on the vertical axis, whereas if you recall earlier there was a floor on -5, and there is potentially unlimited downside. So selling a call alone is a very dangerous, very, very, very dangerous investment. And however, we'll see later that if you sell a call on a stock that you own, it actually reduces the risk of your investment. And finally, the short put, which is again, I flip the put profit over the horizontal axis, and now I have +7. So I stand to make as much as $7, which is the price of the contract itself, but I could lose a lot more money. So it's never a good idea. If you have not traded options, do not start by trading just naked, what we call naked options, options that are not combined with other options or other stocks. Okay. All right. So this is just a quick slide on payoff versus profit. So many times, this is another thing I find that traders, the fundamental mistake that traders make, and that is they ignore the time value of money. So when you are subtracting out the cost, it's important to account for the time value of money. If, let's say you bought the option a few years ago, you buy a long-term leap option, you bought it about 12 or 18 months ago, and you paid that price a long time ago, so it won't make sense for when you exercise it to just subtract out the price. You must account for the time value of money as well. So many times traders will review their payoffs, and payoffs are simply the value at expiration of your position. Okay, so I am a teacher, and in my classes I always make sure that everyone's paying attention. So, whoops, sorry about that. So just a brief review. In your heads, I'm not going to make a poll or anything. In your heads, just give you guys about 10 seconds to review which of these positions, each of these positions are, and then we'll move on. All right, so the top right one is your long call. The top left one is your long call. The top right one is your short call. You can see that it's just a flip around the horizontal axis, around the x-axis. The lower left one is your long put, and the lower right one is your short put. All right. The reason why I'm asking you guys to do this is because as we move forward, you will see how we combine different positions. All right. And finally, there are two kinds of options, European and American, and European options can only be exercised at a fixed time. American options can be exercised at any time. All right. So let's talk about pricing. How do we price these options? Pricing options is tricky. Are they more risky than a stock? Are they less risky than a stock? Okay, just had a quick question on European and American options. I just want to clarify the fact that they're called European and American. Again, another very common mistake, a very common rookie mistake is it has nothing to do with geography. Okay, European options are traded around the world. American options are traded on all exchanges around the world. So it is just, I actually do not know where the nomenclature comes from, but the fact that the key point that we have to remember is that European options can only be exercised at a fixed time, at one time, and that's expiration, and American options can be exercised at any time. Now I will tell you that most index options here in the US are European. Many index options here in the US are European. Lately, they've been, the CBOE has come out with a new bunch of options, weeklies and so forth, which are American. But that's the key thing here, nothing to do with geography. It's not like European options are only traded in Europe and not traded in India. Both European options and American options are traded around the world. All right. So how do you price these options? Are they more risky than a stock? Are they less risky? It's a very difficult question to answer. Fortunately for us, it's been answered already. It was answered back in the early 70s by BlackShows and Merton. And they showed that options can be viewed as a levered stock purchase. In other words, a call option is equivalent to borrowing some money and buying some shares. Okay? And they, of course, came up with the famous and convenient formula for pricing calls, and that's your Black-Scholes Merton options pricing model, which is right up there. Now, it's a very ugly looking formula. You don't have to worry about what all those terms mean. the nice thing for us is that we kind of look at it as a black box. That's the nice thing, so we don't have to worry about all the complicated math that goes behind it, but when you ignore the math, you forget about all the subtleties of the model. So that's what I'm here to remind you about. And one of the key things that we have to remember are the assumptions. So in a Black-Scholes Merton world, so I'm going to just abbreviate to BSM. When I'm talking about BSM, I'm talking about Black-Scholes Merton. Sometimes it's called the Black-Scholes model. I call it the Black-Scholes Merton model because I believe Robert Merton also contributed significantly to that model. Okay, so in the Black-Scholes Merton world, options are European. There are no dividends on stocks. Markets are informationally efficient, which means everyone knows everything that they need to know about everything. Okay. The short-term interest rate is known and constant. There are no transactions costs. The stock returns are normally distributed. The stock prices are log normally distributed. And the volatility of returns is known and constant through the life of the option. For the purposes of this talk, number 7 is the most important. And it follows as a consequence of number 6. All right, which I will show you in a few minutes. All right. Now, the nice thing about the Black-Scholes model is there are 5 easily observable inputs into the model, and this makes the model very convenient to use, and that's also why it has become so popular. Focus of this talk is historical probability, which is historical volatility, which is number 3. So, what is historical volatility? When we're talking about historical volatility, we're talking about the standard deviation of historical asset returns. So what do we mean when we say standard deviation? This is a measure that was, I'm sure some of you will be happy to hear, sort of borrowed from engineering and physics when we look at natural phenomenon, and it is measured as the width of a probability distribution, and it's the square root of the variance. And when we talk about the variance, we're talking about squared deviations from the mean or the average. So already we can see one problem with this. In other words, the higher the standard deviation, the higher the volatility, the greater the fluctuation in the asset returns, the greater the standard deviation. But in the financial world, positive deviations are good and negative deviations are bad. So we're already seeing a problem with the standard deviation. So it's important to understand what it's all about. All right. But I don't want to sort of sidetrack on pros and cons of standard deviation. I want to move forward to implied volatility. So the bottom line is that the standard deviation measures how much a stock return deviates or fluctuates from its average over some predefined period. It depends on what kind of period we're looking at. Okay. So here we have the daily returns of the S&P 500, and you can see there's since from 1950 to 2017, they have fluctuated quite a bit. In some years, on some days, they go down to minus 20%, and that's in one day. And on some occasions, they go up to plus 10%. Okay, so there's quite a large variation, and it's never constant. It's never constant. Historical volatility is never constant. So why do we care so much about historical volatility? Well, let's take a look at PepsiCo. I was talking about PepsiCo earlier. If there is a lot of volatility in the value of the stock, then there is a greater probability that it's going to end up in the money, and that doesn't matter whether it's a call or a put. You can see here on the top half, the blue line is, let's say the strike is $104, and above 104, the option, this is a call option, which is in the money. Below 104, it's out of the money. So if it fluctuates a lot, we can capture great profits. And the potential payoff is large, which means that the options price will be affected by that. Okay, so greater volatility indicates a greater option price. This is for a put option. It's the same idea because fluctuations, as I said earlier, are both up and down. And the greater the volatility, the greater the likelihood that your option is going to end up deep in the money and for a put. And so that's going to be reflected in the options price. Okay. So how do we enter volatility? So when we're using Black-Scholes, usually we use some sort of black box type model where we have our 5 inputs, and these and sometimes 6, because sometimes dividends, we have dividends in there as well. So what do we enter? Clearly, historical volatility, it may work. So is future volatility going to equal historical volatility? Because remember, when we're pricing an option, let's say we're pricing an option that expires at the end of April. So I'm looking at the next 6 weeks or so, or 7 weeks. What is the volatility going to be over the next 7 weeks? Is it going to be the same as the last 7 weeks? It could be, but maybe not. Maybe not. All right. So if we look at monthly volatility of the S&P 500 over the last 60 plus years, you can see that the volatility itself, the standard deviation of the standard deviation is pretty high. The standard deviation fluctuates a lot. Okay, so it's never constant. It's never constant. So the last 7 weeks, it's highly unlikely that the next 7 weeks are going to be similar to the last 7. And here I have just I've created a frequency distribution, and you can see that although it is concentrated over between about 0 and 2%. So these are daily standard deviations calculated over 21 days. So 21 days is the average trading month. You can see it goes from 0 to 2%, and 0 to 2% may seem like a small number, but that can affect your options price quite a bit. And some days, not very often, but some days it goes up to 6 or 7%. So there's quite a bit of variation in the volatility itself. The volatility of the volatility is pretty high. This is where, so the past volatility is not necessarily a reliable indicator of future volatility. So quick question, does anyone look at historical volatility since trading happens on expectations? Yes, so let me answer your question real quick. People do look at historical volatility, which is why I'm talking about it. Okay, and sometimes they're right. Sometimes historical volatility is a good indicator. Okay, many people do, and especially when it comes to the Black-Scholes model. Okay, so what we're going to talk about next is implied volatility, and so what is implied volatility? So implied volatility is when we reverse engineer the volatility from the Black-Scholes model using market options price. Okay, so we enter the market option price. So instead of pricing the option, instead of trying to find the price of the option using Black-Scholes, what we do is we enter the market price of the option and we reverse engineer volatility out. Now, in other words, we input the market option price and we get some volatility. Okay. So this is interpreted as the market expected volatility. It's what the market expects the volatility to be over the period of time that your option expires. Okay. So here I have the time series of the VIX, and the VIX is calculated off of 30-day maturity at the money S&P 500 options, and the VIX is sort of the best estimate, the best publicly available estimate of implied volatility. Okay. Now remember, the S&P 500 itself fluctuates a lot. So the strike price, it's chosen to be closest to the money. Okay. So whatever the S&P 500 value is at the time. So these are across a number of different underlying values. But nevertheless, this is a measure of implied volatility. Okay. Now it turns out that traders often use implied volatility to calculate option prices than the other way around. Okay, it's more important. Black-Scholes is used more to calculate implied volatility, and people price options using implied volatility rather than the other way around. Okay. So it should be the case that the implied volatility should be constant across all different strikes if we're talking about the same underlying asset and the same maturity. However, this is not the case. It turns out the farther away we go from the stock price, the farther away we go from the strike price, the more the implied volatility is different from historical volatility. So this is what we call the volatility skew. And on the horizontal axis here, I have strike as a percent of the stock price itself, and this is from a famous paper by Rubinstein in 1994, and you can see it should be flat. So what we're essentially doing when we calculate implied volatility is we are just, instead of entering the historical volatility into the Black-Scholes options model, we are entering the market option price into the Black-Scholes model, and we get back a volatility. Okay, so it's like an equation where you have two unknowns. You know one of them. You're using it, in fact, to calculate the other one. Okay. So when we're calculating historical volatility is if we're looking at the same underlying asset, it should be constant. Now, pre-1987, it was. Okay, pre-1987, it was constant. It was flat. However, post-1987, what has happened is that we have this skew, what is known as the skew in equities, and it's a smile. It's called a smile in FX options and certain individual stocks. But when it comes to the S&P 500 index, it's a skew, and what tends to happen is the further out of the money you go, if you go left, that is, if your strike price decreases, your implied volatility increases, and if you go right, the implied volatility decreases. Okay? So that's a weird phenomenon that has started only after 1987. And as I said, it's called a smirk for equity options, and it's a smile. The problem is, or the opportunity, depending on which way you look at it, is that this skew is also reflected in options prices. Okay, so the Black-Scholes model works best for options that are closest to the money, where the strike price is equal to the stock price at the time. And here, it should be that these should be clustered very nicely around the diagonal line. But so this on the vertical axis here, I have market price. On the horizontal axis here, I have the Black-Scholes price. They should be nicely clustered around the vertical line, but as you can see, they deviate. Okay, they deviate, and they deviate at specific times, and that's really how we can take advantage of it. Here I have the Black-Scholes error, so that's the difference between market prices and Black-Scholes prices on the horizontal axis and volatility on the vertical axis. And you can see the higher the volatility, the greater the deviation. It should be a nice tight ball around zero and the actual historical volatility, but you can see that the dots are all over the place, and the errors become larger the higher the volatility. Okay, so these are things that we can exploit. This difference between implied volatility and historical volatility or realized volatility is what we can exploit, and that's what I'm going to talk about next. In the interest of time, I'm just going to skip the slides, and I'm going to jump to the trading strategies. But before I jump to the trading strategies, I just want to talk about the volatility risk premium. So the volatility risk premium is simply the difference between implied volatility and realized volatility. Okay, so again, I think I've got a few questions. Can you please explain implied volatility again? So let me just explain implied volatility again. Mathematically, it is calculated as what the Black-Scholes model, so you might think of the Black-Scholes model to be used for pricing options, but what it's used more often for is to get volatility. So we already have an active options market. You already have options prices out there. What people do, what most traders do, is they will look at the market value of any specific option on some specific underlying asset. Let's say we're talking about the S&P 500. Let's say we're talking about a 30-day option. And they'll enter into the BlackShows model a time to maturity of 30. They'll take the risk-free rate, whatever that is. There are 5 inputs into the BlackShows model, and they'll enter all 5. But where it comes to options price, they will enter the market options price, and then they will reverse engineer the volatility from the Black-Scholes model to calculate the implied volatility. Now, the best way to think about, that's how you calculate it. And there are hundreds, if you just Google it, there are hundreds of different calculators you can find online. Very easy to do that, so I'm not going to spend much time on that. I'll spend more time on the concept. And conceptually, it is understood, since we're talking about an option in the example that I just talked about, an option that expires 30 days later. We're talking about an option that expires 30 days later. It is interpreted as the volatility that's expected by options markets for the next 30 days. Okay. So in other words, it is a way to estimate future volatility. Okay, so that's one way to think about implied volatility. Now, before you guys get excited, you might, hey, this is, I can see some people already thinking, hey, this is a quick way I can calculate future volatility. This is where the volatility risk premium comes in, where we take the implied volatility, which is the volatility that's predicted for the future, minus what it actually turns out to be. So what the options markets think it to be, which is the implied part, versus what it actually turns out to be, which is the realized part. So that's known as the volatility risk premium. Okay. In that previous slide, I showed you the error in Black-Scholes prices versus market prices is greatest during periods of high volatility. So it turns out the implied volatility is higher than it should be during periods of high volatility. So we have a higher volatility risk premium. And it also exists for options that are deep out of the money. Okay, typically implied volatility is greater than realized volatility. And a quick and dirty way to look at this is simply look at the distributions of the VIX, which, as I said earlier, is the implied volatility of S&P 500 30-day options. And I'm looking at forward-looking annualized standard deviations. So these are, so the VIX is what Black-Scholes thinks the volatility should be, or what options markets expect the volatility to be. And the gray distribution here is what it turned out to be actually. Okay, and by and large, you can see, although there's a little bit of overlap in the middle, by and large, the implied volatility is greater than on average. Okay, I would say on average, and there are periods of time when it's less, and there are periods of time when it's more, but on average, the implied volatility is greater than realized volatility. Okay. So it turns out, on average, options markets overestimate what the actual volatility is going to be. Okay, so the standard deviation is overestimated by options markets. All right, so now we can talk about how we can take advantage of that. And here I have just a graph of the annualized standard deviation and the VIX. And the blue line, although not all the time, the blue line for a large period, for a lot of times, it is above that orange line. And the orange line is what the forward-looking standard deviation turns out to be. So what I did here was I calculated the standard deviation. Since we're looking at history, I pretended as if I could look forward in time, and I calculated the standard deviation over the next 21 days, next 21 trading days, and compared it to the VIX, which is supposed to be the options expected volatility over the next 21 trading, 30 calendar days, 21 trading days, okay, approximately. And here I have the frequency distribution of the volatility premium itself and you can see that it's centered on positive. It can be negative. There nothing I say here is set in stone. We're talking about financial markets. These are not natural phenomena. These are not the laws of physics here. These are laws of finance, and there are no laws in finance, right? But by and large, you can see that over the last 30 years or so, it's centered on a positive number. All right. So how do we take advantage of this? Let's talk about some trading strategies. So we have the straddle, where you combine a call and a put with the same strike, the same maturity, and the same underlying. Okay, so you can either go long on a straddle or short on a straddle. And here's the profit graph on a straddle, the red line. And you can see that at maturity, if the stock price is very large or very small, if it's far away from the strike price, if there's a lot of fluctuation in the underlying asset, we profit. However, we benefit, so buying a straddle, we benefit from an increase in realized volatility. But do we buy a straddle or do we sell a straddle? Let's think through this. Let's take a second to think through this, all right? So what have we learned so far? We've kind of seen that implied volatility is sort of greater than realized volatility. The greater the implied volatility, the higher the option prices, right? Because implied volatility reflects options prices. So if implied volatility right now is greater than realized volatility right now, options are overpriced. And if implied volatility is greater than realized volatility, that means realized volatility is lower than what options prices reflect, and that's going to result potentially in the straddle expiring out of the money. In other words, there's not going to be much. The options markets predict large fluctuation, but the actual fluctuation is not as much. So putting all that together, we should sell straddles and go short volatility. Okay, and of course there are risks, and I will talk about the risks in a second. I'm just going to go through a quick example with a few numbers here. Let's say you have an underlying stock that's trading at 40, so you buy an at-the-money straddle, so you simultaneously sell a call and a put with strike price of 40. Now I put the prices in there. These are fictitious prices, not real. And what does the profit and loss look like based on the value of the underlying stock? So here I have a few stock prices on the horizontal axis, 25, 30, 35, all the way up to 55. And you can see that if the stock at expiration remains at 40, in other words, there is no fluctuation in the stock price, you stand to gain $9.50. Okay. Now this $9.50 is a fictitious number, but based on what we've learned so far, if the implied volatility is consistently higher than the historical volatility, then options are overpriced, and we can take advantage of that. We can capture that positive volatility premium by selling options, and the straddle is sort of it's a classic strategy that allows us to play around with volatility. Now I did say that there are risks involved, and the way we measure the risks are by looking at the Greeks. So quick and dirty introduction to the Greeks. We have the delta, which is how much the option price fluctuates to changes in the price of the underlying, the stock price. And we have the Vega, which is how much the option price fluctuates to changes in volatility, okay, which is the realized volatility of the stock itself. So for example, if an option has a high Vega, it's very sensitive to changes in volatility. You want to sell options which have a high Vega. But at the same time, look at this graph here. I have Vega on the vertical axis and I have stock price on the horizontal axis. If the stock price, if it turns out that the stock does fluctuate a lot, it goes far away from the strike price, what's going to happen is your option price will no longer be sensitive to volatility. Okay, so that's one of the risks that we are taking. The good thing about the straddle is that if you buy if you simultaneously buy a call and a put, or if you simultaneously sell a call and a put that is at the money, that is closest to the value of the stock price, you get delta neutrality. In other words, you sort of immunize yourself against changes in the price of the underlying. But Vega cannot be hedged away, and this is what I was talking about earlier. Greater fluctuation in the underlying increases exercise potential. So if there's a lot of fluctuation, then the person you sold your options to, the long, might decide to exercise. Okay, and that results in decreased sensitivity of option values to volatility. All right, now I did promise that I'll talk about a few CBOE indexes, and these are easy ways to take advantage of the volatility premium. So there are a bunch of different indexes. We have the BXM, which is a covered call. We have a BFLY, which is an iron butterfly, a collar, a condor, and a put. I'm just going to talk about the first two because we don't have much time. So the BXM replicates a covered call. It's the easiest strategy to understand and the most misunderstood. All you're doing is you're selling a call on the S&P 500 and you're buying the stocks on the S&P 500. Okay. It's a very easy way to get into the options world, especially if you already own a stock. So you don't necessarily have to enter a covered call on the S&P 500. If you already own some stocks, just sell a few calls on the stock. This is your profit structure. Depending on what the stock price is, your maximum potential profit is the call premium itself. But this is very deceptive. This profit graph is very deceptive because what you're really doing is you are reducing the risk of solely holding the underlying. So in this picture that I have here, the blue line are the actual returns on the S&P 500. The orange line is the return on the covered call, on the BXM. So what you're doing is you're selling insurance on the stock that you already own, and you can see that it is a lot less volatile than the underlying itself, and that's also reflected in the distribution itself, where the pink one is the BXM and the smaller one is the S&P 500, and you can see that BXM has a greater frequency of returning a positive return. So you stand to what you're essentially doing is reducing the risk of solely holding the underlying. Okay. So we look at the volatility premium here in the same way as we did a straddle. If the implied volatility is greater than the realized volatility, in other words, if the volatility premium is positive, so we've seen that it can be positive, that means that the option is overpriced, and by selling the call, you're capturing that mispricing. Okay. So this, along with the insurance aspect of it, can result in a fairly large payoff. Okay, and I'm talking about in terms of percent. So some people have suggested to overwrite calls. In other words, you continuously keep writing calls on the underlying that you own over short periods of time, and then you fully capture both the insurance aspect as well as the volatility premium. Again, all of these things has its risks. If there is a large up movement in the stock, your option will be called. Of course, if your stock will be called. Of course, if you already own the stock, then you will lose it. So just be prepared. Don't be too attached to the underlying stock. If you already own a stock, if you're ready to lose it, that's great. All right, and the last one is somewhat complicated. It's an iron butterfly, and it involves 4 options. 4 options with 3 strikes, and this particular index are all options on the S&P 500. and the out of the money strikes are about 5%. The K2 is the middle strike. So what you're doing is you're buying an at the money, you're selling an at the money straddle, and you're buying an out of the money put and an out of the money call. Okay. So I just put some numbers to this just to sort of add some, make it a little bit more concrete. And this is what your profit looks like. So here what you're doing is you are going short volatility just like you were with the reverse straddle, but you are exaggerating your payoff a little bit here. Okay.